Hello, agents. Hello, everyone. So in January, we've seen a lot of interest in the interest-only withdrawals since rates are up so much. So I'm just going to get into some of the pitfalls and some of the advantages of the interest-only versus, say, a split annuity. I get that question a lot. Like, why not just strip the interest instead of doing the split annuity? And it's basically because of the tax exclusion ratio is the main reason we do that. But let's get into the combo annuity for the end of January. So currently a $500,000 split annuity, combo annuity workout like this, 346 gets 5.4. The difference, 153, goes over to the SPIA, kicks off 2118. A month for 10 years, 86.6% excluded, assuming it's all cost basis, right? Non-qualified money. We do not use split annuities on qualified money because you just strip the interest. Always a better deal. In this case, we have the end value of $500,000. These are no value, of course, at the end of the 7 years on the SPIA. And these are the built-in commissions for these two products. It's an A+ SPIA and a very strong A MYGA as well. So those are that's how the split works down. Here's the work on the split. There's the SPIA, the payouts, the MYGA. You guys have seen me do this. I've done a bunch of these videos on my site before. Remember, you could always access extra on the MYGA side if you need to, but it won't grow back to $500,000. Now let's get into the difference between the two. So we're going to look at the split annuity. This is the MYGA and the SPIA. And as you see, we're going to put in $500,000. 346 goes to the MYGA, 153 to the SPIA. It's 5.7 for 7 years, and it'll grow back to $500,000, right? 2118 at 84 payments, 86% excluded. The positives of the split annuity over the interest only here is that you get a steady 86%, a steady income at 86% tax excluded for the whole 7 years. It's a long term and it's all guaranteed from day one. No changes, right? The drawbacks of this is you'll have a large taxable gain on the MYGA side, right? Because the value would be $500,000, but the cost base is only $346. So you have $153,000 taxable gain if you withdraw after the 7th years, right? Income can also not be stopped once it's started in this. And here's the income result. So you get $2,100 non-taxable parts at $1,838. So $283 taxable at 30%. It's about $85 a payment. So it leaves you an after tax of about $2,032. Now let's switch over to the MYGA. The whole $500,000 goes into the MYGA. Same 5.4%. Income. The positives are that the income can be stopped and started at any time. You'll never invade principal. So your death benefit is always at $500,000, right? And no additional taxable interest is added to the annuity, meaning you're taking it all every month. So it's the $500,000 is all cost basis the entire time. The drawbacks of this is all the payments are 100% taxable, if that's a drawback to you. Payments will be based on the days of the month, not level. And after-tax income is higher on the split annuity, as we'll see in the next interest income breakdown here, where you're at the 30% tax bracket. So that $2,258 on a 31-day month after tax is only worth $1,518. And remember, we're at $2,032 on the MYGA. So that's the difference of those two, as you can see, in the end resulting after-tax income. So after 7 years, the MYGA, it has no taxable gain. All has been distributed. So $500,000 is the value after tax. The SPIA has a taxable gain of that 153. So at 30%, after you take the 30% tax, like you'd walk away with $453,802. So, you're just deferring taxes. That's what annuities do. They defer the taxes. You're not avoiding them. You're not excluding them forever. You're just deferring them. So yeah, that's how that would work. And, based on where you're going to be in the future, you can decide if you're taxable now or taxable later, or that bracket's going to be higher now or higher later. Will there be no income tax in the future? We don't know. So, those are all the aspects that go into the thinking of this when you make your decision or when your clients are making their decisions. Now, there's something when their clients are going to be asking for interest-only withdrawals and your rate's 5, let's say I did 510 on this because I can get multiple carriers to match off. So as you see here on this first one, we asked for withdrawal. So if your client says, yeah, I want to take these, both offer monthly withdrawals, but when you on the illustration and you ask for interest only or free withdrawals, it's only going to show you the annual after the year, right? So if the client's taking it monthly, these are wrong. 2550, 2550, see, based on $50,000 at 5.10%, 510. So as you can see, it's 2550, right? So if you say, yeah, you can get 2550, but really, if you take it monthly, it's different. See, some illustration software, the first one here, this one doesn't offer the option to do annually, monthly, whereas the second carrier, when you do the illustrations, it offers you free withdrawals. And how do you want to see it? What mode? And this is very important. Every company should have this because it does cause confusion. You can do monthly, semi-annually, quarterly, or monthly, annually, semi-annually, or quarterly, right? So here's the breakdown when I reran that using the monthly heading, right? $24.92. So that's the correct amount you'd get. It's about $8 less because you're not earning interest on your interest if you take it out every month, right? So this is what this would look like on 31-day month, you get $211. On a 30-day month, you get $204. On a 28-day month, you get $191. Of course, that's how it would break down for the term. So be aware when you're illustrating and you're telling clients that, yeah, you can take it monthly and you run an illustration, oh, you get $2,500 at the end of the year. You won't. You'll get $24.92 if you take it monthly. So that's just a little heads up there. I have a full Excel spreadsheet that I can dial in pretty much any of the numbers and give you the monthlies based on the days of the month. So that's pretty cool. So yeah, if you want a MYGA or SPIA, a split or a MYGA illustration, just go to annuityexperts.com, click on that MYGA rates tab. It'll highlight those two. Pick on which one you want, deferred or split annuity. It'll bring you to the quote, fill it out. You'll get this nice little form if you did it correctly. Here's some disclosures. And yeah, that's the end of my presentation. Thanks for watching. Interest-only withdrawal is really hot. As interest rates go up, people can take a longer income. Or if they had been taking interest in the past, you're seeing raises of like 30, 40% with the new increases. So yeah, interest-only withdrawal is a really great way. Everything's guaranteed from day one. Just know how to explain it and quote it. So X, YouTube, LinkedIn for the most up-to-date information. Thanks for watching. Take care, everybody. Bye-bye.